Nicolas Bérubé, it's great to welcome you to the Rational Reminder podcast.
Thank you for having me.
Hey, great to see you, and congratulations on your book.
Thank you.
So let's dive right in. What did you learn from your failed options trade before you started studying markets?
Well, I learned that losing a good chunk of your money very quickly is not fun at all. And so when I started investing in 2010, my big genius idea was that the S&P was going up, 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 way, way, way too quickly. And I was living in LA at the time. So the fact that around me, a lot of people were losing their jobs, a lot of people were losing their house. So it made no sense to me that the market was so quote unquote healthy. And I went online, and what do you know? I found a lot of people who thought the exact same thing. So I had confirmation bias really, really quickly in my investing journey. And so, as I say in the book, I lost about $10,000 in a matter of months because I bought put options on the S&P. And so what did I learn? I learned that my gut feeling was absolutely not to be followed at all in investing. And so really that kind of drove the point to me that the market doesn't really care how you feel. It doesn't care about your macro views. It doesn't care about what you think the price of oil is going to be a year from now. So the human brain really is not well equipped to be an investor. So, you can read about it, but once you experience it, you really tend to not forget it.
Hmm. You also tell the story in the book of a conversation with a friend of yours in a cafe, I think, and he was going through similar thoughts about the market crashing and all this kind of stuff. What do you think people like that and like your previous self can do to become optimists, which I think you've accomplished through your research on this?
Yeah, it's really hard. I think first of all, being slapped sober by the market kind of helps because
Hmm.
you kind of there's no way you can hide, right? The numbers don't lie. So that's kind of that was helpful. Myself, I was never quite an ideologue. I was never like against the Fed or really I had kind of a strong opinion held loosely kind of
Hmm.
approach. So the fact that I lost money was kind of a wake-up call, but it pushed me to get more and better data. So one of the first book I read after that was A Random Walk Down Wall Street, that
Hmm.
Burton Malkiel that you guys invited on your show. And that book really made an impression on me. The systematic approach to investing, the way forecasting is kind of pointless, and you don't even need to know what the forecast is for the next year or two or anything really. So that really was helpful. There's another book. I don't think it gets mentioned that often. It's a book called Everyone Believes It, Most Will Be Wrong by Morgan Housel, who was on your show not too long ago. And that book is a kind of a collection of his essays for The Motley Fool. It was published, I think, in 2011.
Hmm.
And you can download it on Amazon. It's an ebook. It's $1 on Amazon, so probably the
Hmm.
best dollar you'll ever spend. And it's really what comes across in these essays is optimist and his way of looking at the world through a long-term view. So across many data points for human success or for health, for education, for wealth, throughout history, we're on a good trend, and it's kind of hard to notice that on our day-to-day lives. So Morgan has a way to explain that is, I think it's very, very compelling. And the last thing I would say is that you need role models. I mean, I don't think we
Hmm.
mention it a lot. Imagine if Warren Buffett and Charlie Munger and Jack Bogle, imagine if these people were pessimists. Like, imagine if
Hmm.
every time they opened their mouth, it was like, oh, everything is so terrible. Inflation is going to eat you alive. I mean, how would we go about investing our paycheck every week? I mean, it's hard to quantify, but there's something. So be careful, the role models you choose, you tend to keep them for a long time. So be very, very careful. And so, yeah, so that was helpful for me.
So you had the chance to meet Monish Pabray. Perhaps tell us who that is and what did you learn from that meeting about investing?
Yeah, Monish Pabray is an Indo-American investor. He manages hundreds of millions of dollars, and he's been very, very successful in the market. And so I think it was 2013, when I was still in LA, I contacted him and I had the opportunity to meet him at his office with a bunch of UCLA students, and he was super kind. He talked to us about his way of investing, and one of the big takeaways for me was his calm. And I don't know if many people know that story, but in 2008, the fund that Monish Pabray manages lost 67% of its value in the 2008 crash.
Wow.
And a few years after that, his wife was looking at his old annual report, and she saw that figure, 67%. And she went, wow, I had no idea. And she said, I had no idea because you didn't change in 2008. Like you were not angry, you were not stressed, you were not different from the year before that and the year after. So, and that made a big impression on me. I mean, wow. And I mean, we like to talk about volatility and I think sometimes these words are kind of a bit too polite, because when you're down 67%, I mean, it's quote unquote volatility, yes, of course, but it can be more than just a little word like that. So it made a big impression on me. And another thing Monish Pabray talked to us about is about stacking the odds in your favor. So the way he meant it was, he's buying a few bets, and even if some of those bets, don't work, it's not matter, because he's not betting the company on every bet. And as index investors, we don't really make bets like that. But if you're going to buy the whole market, and even internationally, you'll have part of your investments that will do well and parts that won't do well. So in a way, this is what we do. We stack the odds in our favor and just accept that at some point in time, some investments will work better than others. So that's just part of the cycle. It's nothing to worry about. And last thing, Monish Pabray, he showed us in his office, he has a little room where there's a bed, so he can take a nap every afternoon. And I remember being very jealous of that, because I'm not a napper. So I thought it was kind of cool that this is what he's like, yeah, I take a nap every afternoon. I think way more clearly after a good nap. So that was cool.
That is cool. Can you talk about how you would describe investing in the stock market being different from playing in the stock market?
Yeah, as I say in the book, I kind of hate the word like playing in the market. And I know sometimes people mean well when they say that. It's just a natural way to approach the market. And it comes from this kind of casino mentality, right? That most people who have not spent a lot of time thinking about the market have. It's kind of the default mode where, if you want to do well, you have to find the next NVIDIA or the next Apple or the next Google. That's what I think is probably the default mode about how people think about the market. But the main difference, I would say, is the time horizon. If you want to, stack the odds in your favor, you have to have a long time horizon, and that's mean thinking in decades instead of years. So, to me, that's the big difference. And I would say the other difference would be a lot of people want to see a quick gain in the market. Even some people who should know better. Like I get email from readers all the time, like, oh, I did 30% since Christmas, or these kind of things. And people get excited. And I never really know what to answer, because it's hard to, you don't want to rain on their parade or anything, right? They're not lying to you. But at the same time, when you understand that, the real growth in the market doesn't come from 1 month or 1 year or even like 5 or 10 years. It comes from a lifetime of investing, and that's hard for people to understand. It's not a game of, who's ahead after the mile 4 of the marathon, right? If you crash in the middle of the marathon, it won't matter who you were in front for the first few miles. So understanding compounding and understanding that your gains will come from compounding, and compounding doesn't care whether you do 60% or 30% this year or 10% this year. It doesn't matter. It's just staying the course for a very long time stacks the odds in your favor. So that's what I would say.
Yeah, and in your book, you linked that to what you called infinite vision, kind of a tribute to Simon Sinek, of course. So perhaps can you talk about why it's important to have that infinite vision when investing?
Yeah, exactly, for sure. Because sometimes I get readers write me, "Oh, I'm 50 years old. I'm going to retire at 65, so I have 15 years. And what should I pick, and how should I invest?" I always tell people, "Wow, you're 50 years old. You don't have 15 years left. You have 45 years left. Like, you're an investor for all your life." So people sometimes don't see it that way. So and yeah, so seeing the infinite game is basically the only game in my mind in investing. And that's why sometimes it's a misnomer when people use the word average, because if you're going to buy an index, you're going to get the average return, and average is not super exciting. Who wants to be average? Nobody wants to be an average golfer or average student. But what people miss sometimes is average over 5, 10, 20, 25 years. You're not average anymore. You're in the top 10 or 5% of investors just because of compounding. And that's hard for people to understand. They want to see progress quickly. They want to see, when readers, when we get a good year in the market, readers, they say, "Oh, I followed your advice. I indexed my investment and I had a good year." And I tell them, "Well, you're excited about your investments are costlier to buy now. It's not in your favor. It's like showing up at the supermarket and everything is expensive." People are not happy about that, but in investing, for some reason, they're super happy. And so that's, the notion of average is, I think it's interesting, and it's fascinating how it really works.
If a reader comes to you and they maybe don't know about index funds yet, how do you explain the benefits of index investing to them?
Well, the first factor to me is simplicity, and there's no guesswork involved. You don't have to look around corners or anything like that. You just buy the thing and forget about it. I tell people I spent less than an hour a year managing my investments, and that's including the time to brew a good pot of coffee. So it's not a really full hour. So the simplicity is very hard to beat. Also, one of the big data points, and I know you guys talk about this a lot, it's that if you look at the stock market during, historically, the growth of the stock market comes from the studies I've seen, from 1 to 4% of publicly traded companies. And the day I understood that, it's hard to forget it, right? 1 to 4%. I mean, and the cherry on the cake is that it's never the same 1 to 4%, every decade and so the chances that you'll get those companies, it's not great. So if you buy the whole haystack, it removes a lot of the guesswork, and it removes a lot of mental energy, and you'll have the Googles and the NVIDIA of the world. They'll drift to your portfolio whether you pay attention to it or not.
Exactly. How big of an obstacle do you think behavior is to investment outcomes?
To me, behavior is the number one obstacle. I mean, if you don't have behavior, you don't have anything, really. It's as simple as that. Jack Bogle used to talk about the enemy in the mirror, and I use that analogy a lot because people think that their enemy is the next crash or the next recession is their enemy. They don't realize that they're their own worst enemy in investing. It's hard. I mean, not many people are willing to admit that. I have a friend who a few years ago was telling me about his performance in the market, and he was choosing his companies very, very carefully, reading annual reports on the weekend. And I tell him, well, go online, go on portfolio visualizer and look if you beat in the market. And he did that and he hadn't. So he changed all his portfolio for an index portfolio, and very few people can do that. A lot of people gets passionate about their dividend or their choice or on their view of the world. But if you're dispassionate and you can do that, it's super rewarding. And also, I think doing nothing is hard. I mean, a portfolio manager told me recently about a client of his who has a sailboat, and the client was like, "Look, if I'm on my sailboat and there's a storm coming, I'm not just sitting there doing nothing. I'm going to actively try to protect myself. I'm going to find a harbor. I'm going to do something." And in investing, it's so intuitive to try to do that. And it's so rewarding. It's like we're programmed as humans to do that. But to tell someone, no, there's a storm coming, you don't know whether it's a big or a small storm, or even if there's a storm at all. And if there's a storm, you don't know when it's going to end, right? So it's fascinating to see that it never changes. And if you're able to master that and master your behavior, you're more than halfway there.
I've definitely had that benchmarking conversation where someone says like, yeah, I've beaten the market. And it's like, okay, well, let's benchmark your returns. And then they go and actually look compared to an index. And most of the time they've underperformed. Yeah. But people don't do that. They don't benchmark the returns. So they just assume if it went up that they've done well. On the topic of investor behavior, what effect do you think the financial media has on investors?
Yeah, as a journalist, I can tell it's not great. I mean, the media is always after the shiny new thing, whether the market is up or down. I mean, when the market is down, it's all about 5 ideas to protect your money or 3 stocks that did well last year. And, it's the rear view mirror effect is always there. And I always tell people, if following the news made you rich, I mean, journalists will be multimillionaires, and I'm here to tell you that they're not. So on aggregate, their returns are not super exciting. It's anecdotal, but so I think we need to have a healthy, skeptical look about on basically what we read in the daily paper. It's the nature of the media to go after what's shocking and surprising. I mean, and also negative. I mean, if we all know that if there's a 8% drop in the market, I mean, it's going to be front page news the next day. But sometimes when the market goes up by 8% the next week, it's kind of barely noticed. So
exactly,
I think people get the idea. If you're a follower of the news, you don't really pay attention. You get the idea that the stock market, it's this big, big, big risky endeavor that's really very few people understand, and you should really, really don't do anything with it, let alone put your money into it. So so I think it's not super, super great. I think obviously there are exceptions, but I think it's John Galton, the researcher, who said that if newspaper came out every 50 years instead of every day, all the news would be super positive, because the long-term trends are about people getting wealthier, healthier, living longer lives. So the nature of the news cycle is kind of not super helpful for investors, unfortunately. Yeah.
Do you get any, as a journalist, do you get any like editorial pressure to write about more short-term stuff?
Not really. No, it's well, my beat is a bit different. I have a weekly column on Sundays called it's in French. It's called Money and Happiness in French, and I really have no editorial pressure at all. I think it's just the nature. Some people get excited about what the market does this week and today, and who bought what and who's selling what, and there's a market. There's people interested in that, and that's okay. And also, it's interesting to see, the GDP, but as soon as we step into projections or predictions, I'm completely out. I'm just not interested, and I'm just for fun. At the end of the year, I do a little review of the predictions, and oh my God, it's almost to the point. I mean, they bottom tick every trend. It's almost scary. I mean, at the beginning of 2023, people wouldn't touch tech stocks with a 10-foot pole, and what do you know? In 2023, it did incredibly well, and so same thing with gold. And some people are interested, and there's a market for that, but I just tend to drift towards things that are more, long term and doesn't really change from day to day.
Earlier, you mentioned that you manage your portfolio and make a pot of coffee in about an hour a year. Do you have any thoughts about how investors should decide between do-it-yourself like you, robo-advisors, or delegating to a professional?
Yeah, I think it boils down again to behavior. I mean, if you behave well around investments, a DIY route is probably good for you if you have an interest in that. Some people have, you can tell with a 5-minute conversation, usually if someone is interested, and if someone has the right behavior, but maybe no interest at all, I sometimes tell them, just to go with a robo advisor and set up automatic transfer and forget about it. And so, if you want someone to manage your investments, it's not super easy in Canada because, of course, the big banks are usually they will bill you a portfolio of actively managed mutual funds till in 2024. So, and if you don't have the minimum amount to invest, usually it's $500,000. Many good firms won't take you on as a client. So I tell people they should, maybe go the robo-advisor route and see if it works for them, and eventually find a financial advisor who will manage their money for them. And that's usually how it works for me. I used to be more pro do-it-yourself. It's so simple, but I changed my tune a little bit on that. It's easy when you do it yourself and you've found, joy in that, or I don't know if you find it interesting to follow that. But it's hard for me to tell a 57-year-old, manage your own money, you'll save 1% a year or anything like that. I mean, it's a big leap of faith. I mean, people have so many questions. I think you had Rob Carrick of the Globe and Mail on your podcast, and he mentioned something along those lines. Like, I get so many questions, and it's the same thing for me. I could do that all day long, answer email of readers about what should I do, and what does this mean, and what would you do if you were in my shoes? And so it's just a never-ending streams of questions. So that gives me pause. Not many people are comfortable, even if it's simple. As you know, it's simple, doesn't mean easy.
Right.
Yeah, it's super interesting perspective. That's not the first time that I've heard that from somebody who found DIY investing themselves and figured it out and thought it was easy and loved doing it and built their portfolio, and then started writing about it and interacting with other people and telling them how easy it is. But then once they see all the questions start coming in from people and the things that people get stuck on and where they struggle, you kind of come to the realization that, like you said, even though it's simple, that does not make it easy. And people get hung up on stuff that you just can't even imagine would be a hang up if you figured it out yourself. But actually figuring it out, it's not so easy.
Yeah, and if the person is young, is like an 18-year-old, you say, yeah, sure, just open a robo advisor and get familiar with the market, the up and down. I opened an account for my son. He's 11 years old. It's in my name, but he's getting familiar with the ups and downs of the market. So he won't be freaked out in the future about that. But a person who starts later in life and has a bit of money accumulated, wow, I wouldn't recommend them to just go about investing it themselves, even if it's simple. I mean,
Right.
they will maybe freak out in a market storm, and so there's so many things that could go wrong.
Yeah, it's totally true. I even see I agree robo advisor is a great solution for a lot of people, but I see posts on Reddit all the time about Wealthsimple users who are saying like, my Wealthsimple portfolio is down 2%. Like, should I sell it?
Yeah, yeah. No, yeah, it's a never-ending stream of questions, and
Uh-huh.
and that's why, I mean, resources like you guys, like Andrew Hallam, who was on your show not too long ago. I mean, all these analysis, and it's super helpful because people can we could all tell them very quickly. You just need an index card basically with what you need to do to invest well. But if it were that easy, I mean, it will be known. It would be known by now, but it's not. It's super not easy at all. All the fear and the uncertainty is just too much for the human brain.
Someone's made this comment before. I didn't come up with this, but I have a book behind me somewhere called The One Page Financial Plan, and it's a 300-page book.
Yeah, that sounds about right.
That is
Yeah.
funny.
Okay, on the topic of delegating to a professional, if someone decides that they do want to do that, you mentioned that in Canada, a lot of the time they're going to put you into actively managed funds. What do you think people should be looking for or avoiding if they do seek out professional advice?
Well, I think you need to go with low fee index funds. I know historically they were hard to find in that space, but since I think 2022, there's some index mutual funds that are available in Series F in Canada, and I think they have something like 20 basis point or around that. So people can go, ask their financial advisors about that, and they can ask about the fees they're paying. I think if they're paying 2%, it's way too much. To me, that's a red flag. You shouldn't be paying 2% on your investments, because think about it. If you're paying 2% and inflation is 2 or 3%, you're already at 5%. Okay, so if you make 5% in a year, you're basically sitting still, not increasing your wealth.
Okay.
And so that's hard to people to understand. And there's a big opportunity cost there. If you're young and you have many decades ahead of you, it can mean having half of the money that you would normally have if the fees were low. So that will be the main thing I would tell them.
Yeah, the fees are hard. Like there's right now, firms are required to disclose fees paid like for advice to the firm, but not the mutual fund MERs. Like in statements, we're required to disclose that. Full cost disclosure is coming, but it's not here yet. And so I had an interaction on Twitter recently where somebody knew the fee that they were paying to the firm, like to a fee-based firm for advice, but they had no idea what they were paying on the funds that they own. And so it ended up being a little bit less than 1% that they're paying for advice, and they thought that was their fee, but they were paying an additional, I don't know what it was, 1.5% or 1.2% or something for the fund that they own. So it ends up being way more expensive. But yeah, asking about, I think people have to understand there are two layers at least of fees for even a fee-based firm. So you've got to ask, what am I paying to you for advice? And what are the fees and the funds that you're using in my portfolio?
Exactly, yeah.
Nicolas, you interact, as you said, with a lot of your readers. What do you think investors struggle with the most?
I would say it's a lot of it is recency bias. So if the market, if an area of the market has been on a tear and it's super well performed over the last year, people are excited about that. And if something hasn't well performed, they're they think there's something wrong with it. I keep telling them now. I keep getting asked about the S&P 500 all the time, but what I keep telling people is like 10 or 15 years ago, you wouldn't have asked me about the S&P 500 because it was super unpopular after the first decade of this century. The S&P, basically you couldn't give it away because people were tired of crashes after crashes, and the US was this country that was on the verge of a massive depression, and people were not interested. And so, yeah, recency bias is super strong. And also, what I realized is that people want to see progress. Okay, so if there's a year without progress, it's like the markets are broken, or the way to invest is broken. It's almost like a car that only goes backwards. They're like, there's something wrong with that car, like fix it. And I'm like, no, it's normal. Like, you don't need to fix it. It's just the markets. This is what markets do. It's usually they go up, but sometimes they go down. So that this year or this number of years, they've been going down. And that's hard for people to understand. They wanna open the hood and do something, and that's super hard to understand, and viscerally to just do nothing. It's not satisfying, but that's what I try to tell people.
Awesome. The book is From Zero to Millionaire. Great book. Nicolas, great to have you join us.
Thank you. It's been a pleasure.